Hello, everyone, and welcome to today's edition of the Macro Microscope. This is the December 2024 edition, and today's topic is New World, New Playbook. And as always, the two presenters, I'm Indrani Day, Head of Global Investment Research in FTSE Russell, the index business of the London Stock Exchange Group. And I'm joined by John Dioufas, Director, Data Stream in the London Stock Exchange Group. And with that, let's jump into today's presentation. So the way we are going to structure it is first, I'll be talking about some differences we are seeing in how financial markets across different countries are behaving. Very different behavior from what we have seen for a very long period of time. And I'll touch upon both fixed income and equities. And then I'll hand it over to John, who will do a deeper dive into the macro drivers in terms of inflation and rate and currencies that explains this different performance across countries that we are now seeing. A quick note on the disclaimer, as always, FTSE Russell is not an investment advisor, and everything said in this presentation is purely for educational purposes. So with that, let's jump into what is happening in the EMEA region. Now, remember, for a very long period of time, we always, had this conception that the peripherals are the weak spot in the European economy. And we saw that in the Eurozone debt crisis after the post-financial crisis. But in recent years, how the peripherals are behaving within Europe is completely different. So right now, the chart that you see in front on the slide, it's the annual percentage growth in GDP across some of the major economies. And we are rebasing it to end of 2019 to pick up on the post-COVID trends, which is the blue line that you see right on top. It's Spain's GDP growth. Spain's GDP growth today is far higher than Germany, traditionally the economic powerhouse in Europe. Now, coming to the financial markets, now here there are two charts. On the left-hand side, you're looking at the government bond returns. On the right-hand side, you're looking at the investment grade corporate bond returns. And again, the charts go back 10 years in time and the vertical lines point out to around 2022, because it's since 2022, you're seeing markets behave very differently. Spanish and Italian government bonds on the left-hand side, they're clearly outperforming, the core France and Germany. And the same thing on the right-hand side, you see with the investment corporate bond returns. Spain and Italy have been really outperforming in the fixed income space with a reference to Germany and France, the traditional powerhouses. And coming back into even more risk assets, this chart shows the same for Italy. On the equities front and the high yield credit, the risk assets front, again, you see from 2022 onwards, Italian equities, Italian high yield credit has really outperformed, both in the broader Eurozone area and their core counterparts. This decoupling is very evident since 2022. Switching gears a little bit and turning to the APAC region, many of us over our careers, we started with Japan's lost decade of fighting deflation. But today, Japan has pulled out of that deflation and Japanese yields have started going up, whereas it's Chinese yields that are now going down as they have more concerns about their growth model. And, so you see that reflected in the relative relationship between Chinese and Japanese yields. The purple line is Chinese yields, the gray line is Japanese yields. On the right-hand side is the really long 20-year plus, where you see that they have actually crossed and, they are now in line. Whereas on the left-hand side for the 10-year, again, you see the same trend where Chinese yields are coming down, but Japanese yields are coming up, but they haven't still caught up the way they have on the 20-plus year. So what does it mean? Like Japan's lost decade fighting deflation is over, but is China heading in that direction? That's certainly something to keep an eye out on. And with that, I'm going to hand it over now to John.
Thank you, Indrani. Keeping on that topic and moving over to the Chinese yield curve, if we look at how the yield curve is performing as of the latest data, as opposed to how it looked at the end of Q3, we will see that the red curve is basically priced underneath where it was in the past. So the yield curve has basically shifted down across almost every tenor point bar the 15-year tenor point. And that basically means that the market is pricing in lower future interest rates for China given the prospect of deflation in the Chinese domestic market. On the flip side, if we were to go to the United States yield curve, we see a very different picture. We see that the yield curve has shifted up as per the latest data when compared to quarter end of Q3 of this year. So basically from the 1st of October onwards. So what we can see is the market is pricing in higher interest rates for the future because it believes that inflation is going to be stickier in the US domestic economy than what most people are giving it credit for. And what does that do then when we look at interest rate probabilities for central banks? Now, go back 2 years, basically all central bank monetary policy had converged. They were all hiking rates, with the exception of Japan, of course, but everyone else was hiking rates because they needed to control inflation. Since then, what's happened is we have a situation where the different domestic markets, different domestic economies have evolved differently as a result of higher interest rates. And now we see a picture of very divergent interest rate policies by the central banks, a combination of cuts, no changes, some hikes as well, both as a most probable or the least probable action by central banks. So we really start to see different monetary policies taking shape and being implemented. And what that will basically result in is when we look at these different domestic markets, in inflation differentials that are quite different. Now, what we're looking at here is a chart in blue of the dollar index versus the euro dollar in purple and the Japanese yen in red, those two being the US's biggest trading partners and therefore making up the biggest trade weighting as two currencies versus the dollar. And we basically see two currencies that behave opposite to the dollar, as would be expected. But going forward from the 22nd of November this year, we start to see that the dollar's coming off slightly, the yen is moving up slightly, the euro is moving up slightly. But in essence, it's a story of dollar strength versus euro weakness and yen weakness. However, we do know that the yen is most likely going to start to appreciate as the Bank of Japan has got inflationary concerns it needs to deal with, whereas maybe the dollar has the Federal Reserve in the US markets is a little bit less concerned about inflation and might start to cut. So it's a very interesting scenario going forward. Thank you for joining us for the December episode of Macro Microscope. Have a good day. Bye-bye.
Thank you.